Hey, what's up, my friend? So in today's episode, right, I want to talk about the top 7 Forex trading rules for beginners, right? So number 1, trade your time frame. So what do I mean by this? So if you're a Forex trader, you know that, there's almost a lot of time frames that you can look at: 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 8 hour, daily, weekly, or even monthly. So here's the thing, right? If you don't define the time frame that you're going to trade at the start, then what's going to happen is that you'll be, all over the place. You'll be on a 5 minutes, 30 minutes, 4 hour, 1 hour daily time frame, right, to look for trading setups, and you're going to get analysis paralysis.
Oh, the daily time frame is in an uptrend, Rayner. But on the 15 minutes time frame, it's a downtrend. So which time frame should I follow? The 15 minutes or the daily?
And then you go to forum, you ask for help, blah, blah, blah. So here's the thing, right? Once you can define your time frame, once you only stick to your time frame, once you just trade your time frame and ignore everything else, things become much more clear-cut because you know what to focus on, right? What's relevant to your trading. And the rest is just noise, alright? So trade your time frame and ignore everything else. Number 2, don't follow a signal service. So a Forex signal service is where someone says, buy euro dollar, right? 50 pip stop loss, 100 pip target. Don't do that, right? Because when you put your trading in the hands of someone else, then what is going to happen is that you will never pick up the skill of trading. And number 2, when that system, that strategy goes into a drawdown, meaning you encounter a series of losses, you will lose, right? I can guarantee you will lose the conviction, right, to follow the person because you're unsure, man, has this trading strategy stopped working? Man, what's going on? You have all this kind of, conflicting thoughts in your head. So don't even start with, right? Don't follow signal service. It is just the best, right? For your overall trading career. Number 3, don't use fixed lot sizes. So this is a mistake many traders also make because, it's simple, right? I just risk one mini lot on every trade, right? So this way, it's easy to put into the MT4 platform, for example. But the problem with this is that different pairs have different volatility. You can't compare the volatility of, let's say, dollar yen to dollar Canadian. It's different, right? And on top of that, different pairs, their pip value is different as well. So if you use a fix, for example, one mini lot on every single trade, what's going to happen is that sometimes your losses might be $200. Sometimes it might be $1,000 and you're not sure why. And that's precisely why, because you're using a fixed lot size, right, for different pairs, with different volatility, with different pip values, etc. 4th thing, don't set your stop loss, right, or rather the 4th thing, right, set your stop loss away from price structure. So what this means is that whenever you place a stop loss, right, in the Forex market or even the stock markets, you want to set it at a level, right, which invalidates your trading setup. You want to set it at a level where the market has, difficulty reaching your stop loss. So what I mean by this is that if you are in a long trade, you buy because there's a, let's say there's a bullish setup, then your stop loss, right, want to be at a level where the price has difficulty, heading lower. This could be, maybe because your stop loss, right, is below support. So as you know, support is an area where potential buying pressure, could step in and push the price higher. So naturally, you want to set your stop loss, right, below support, a distance away below it. So this way, if the market were to reach your stop loss, it first has to break support. So you have to make the market work hard to reach your stop loss. Can you see where I'm coming from? So this concept, right, can be applied to whether is it FX, stocks, whatsoever, right? You can apply it on different time frame as well. Basically, you want to identify the price structure on the chart, the nearest price structure, and then set your stop loss away from it. The price structure could be something as simple as support. It could be an upward trend line. It could be a moving average that the market respect, right? Set your stop loss away from this price structure. So the market, right, has to work harder to reach your stop loss. And this way, right, you kind of, would stay in your trade longer and not get stopped out unnecessarily based on just, random whips or random noise in the market. 5th thing, right? Follow the price, right? So this is again just a rule of thumb, right? Whether you trade stocks, FX, or whatsoever, follow the price. If the market is heading higher over time, then look for buying opportunities. Don't try to be a smart aleck and say, oh, the market is too high, it can't go any higher, it's coming into resistance, it must come down lower, let me sell. No, that shouldn't be your top process. Your top process should be, I know nuts. Market is from left to right, it's going up, I'll look for buying opportunities. Oh, from left to right, it's heading down, I'll look for selling opportunities. That is as simple as it should be. But funny thing is, as traders, right, the longer we trade, right, the more we complicate things. We add in fundamentals, we add in, multiple time frame analysis, we add in all this conflicting information, right, and we end up, doing things that shouldn't be done. Okay, so number 5, just follow the price. Number 6, have a trading plan. So what is a trading plan? So a trading plan is something as simple as a plan, right, that tells you when exactly to enter a trade, when you will exit the trade, how will you manage the trade if it moves in your favor, how will you manage the trade if it moves against you, which markets you'll trade, which time frame. So this is a plan, right, that covers everything from A to Z, because once you're trading with a plan, then there's no more guessing, right, there's no more subjectivity because you know what to do, right, ahead of time every single time. And it's powerful because it gives you, right, the confidence, right, to put on a trade, right, knowing that whatever happens, right, you are in control. Compared to, following a signal service where you don't know what's going to happen, who that person is, etc. Having a trading plan puts you in the driver's seat. You are in control. And finally, number 7, trading rules. Rules are meant to be broken. I know that sounds ironic, right? Rayner, you just feed me the top 7 or the top 6 trading rules, and number 7, you tell me rules are meant to be broken. Yes, and let me explain why. It's because context matters, right? So for example, some people say that to make money in the financial markets, you got to buy low, sell high. That sounds like, yeah, Rayner, that's right, man. But hey, who says you can't buy high and sell higher? Yes, you can as well, right? Especially momentum traders. So you can see where I'm coming from, right? Is that rules, right? They are there to guide you. But once you understand the principle behind those rules, then you can actually, you can even tweak those rules, right? To suit your circumstance. So I just give you one example, right? Being from buy low, sell high to buy high, sell high. Or how about this, right? Never average into your losses, right? That's again a pretty common rule, right? That's even I myself, I share it a few times on the few episodes, right? But at the same time, right, for experienced traders, if they know that the area of support is, let's say, is pretty large, they can average their losses, right, as the price, sink in deeper and deeper into support, because they're getting, they're buying at an even cheaper price. But that must be done, right, correctly with proper risk management, where, if the price goes into support by too deep, right, they have to, eventually cut their trade, right, when they know that support is eventually broken. But what if the support is a huge area? They can average into their losses 2 times, 3 times, right? That's possible because they know they are trading within a huge area of support. So as mentioned, right, you've got to understand the principle behind the rules, right? Then right, can you bend or tweak the rules, right? So that's kind of number 7. Okay, so with that said, let's do a quick recap. Number 1, trade your time frame. Number 2, don't follow a signal service. Number 3, don't use fixed lot sizes. Number 4, set your stop loss away from price structure. Number 5, follow the price. Number 6, have a trading plan. And number 7, rules are meant to be broken. So with that said, I wish you good luck and good trading. I will talk to you soon.